Welcome to the channel and thank you for coming back. So, first of all, if you're copy trading, you are an absolute moron and you deserve to lose all your money. And please know that all this information is for educational purposes only and does not constitute investment advice. And with that out of the way, today's stock is an organization called Targa Resources Corporation. What do they do? Well, they are quite active in the midstream business in the energy sector. For those of you who don't know, they essentially process and store natural gas. So it's not a part of the extraction of these kind of raw materials, it's more the processing and storage and transportation. So, what happened with them in the past? Well, this is a company that had very, very strong dividends. Let me zoom in the chart. As you can see, big drop in 2020. These dividends that they had were crushed during the pandemic and they are now turning around. Now, do we think that they will recover? Because the stock is now at a higher price and has doubled their dividend compared to that time. At the same time, around here in 2022, the company was upgraded to investment grade by three different rating agencies. So that obviously becomes a much more appealing asset for investors around the world. Now, let's look at the micro situation for a second, because as you can imagine, what happens with oil, gas, does impact what's happening with the company. And one of the key drivers of that, of course, is the manufacturing PMI, which has been kind of wobbly, if not poor, for a number of months. But do we think it's going to get much worse? Well, probably not. Um, we should see some kind of activity continuing, right, on the manufacturing side. Maybe it doesn't recover anytime soon, but probably it's not going to remain much worse. So if it just stays the same, well, we'll talk about that in a bit. But if it goes up, obviously that can be a good thing for the stock. Now, what happens if it actually just stays around the same? Well, we have to think about the business model of these guys. They're not necessarily the same business model than an oil producer does, right? Which is okay, I extract oil for $5 and I sell it at 10, and whatever the differential, I make a profit. These guys are not in that kind of business, right? They have contracts that are fee based, and that means that what moves the needle in terms of the earnings is the volume. So what they really care about is okay, well, how much gas is being processed, how much is being moved around. That's what's relevant to them. Obviously, if the price of natural gas goes up, yes, that will be a good thing as well, because if supply is low, then they can release that supply at a greater price. But we have, or at least I see here, a couple of different scenarios. One that is kind of flattish but positive nonetheless, and we'll explain that in a minute. Another one which could be a little bit more bullish if energy, uh, you know, goes up a little bit, and that is, by the way, not far fetched because let's go back quickly here. Let's take a look at, so here's a different way of seeing stock. Let's take a look at the energy side. So XLE down, quite oversold, right? So we do see that, uh, and the energy ETF down as well and oversold, pretty much the same thing. So we gotta ask ourselves, do we think that this sector is gonna it's going to get much worse than it already is. Well, probably not. And we don't necessarily expect the economy to come back roaring immediately, but it doesn't seem that there's alarms going on. So that's what we have here. Let's go back to the chart. Uh, Here, yeah. So coming back to the natural gas, at the moment, a lot of the tensions that were created back then because of the war in Ukraine, with natural gas prices going up, have eased a lot. But the interesting thing is that the ratings agency Fitch has upgraded or has updated, better said, their assumptions for 2024. And here's a snippet that I find quite interesting, which I'll read here. They say US gas production continues to outstrip consumption increases, although the gap has decreased in line with previous expectations. Production continues to grow from a combination of associated gas from oil focused drilling and natural gas focused drilling last year. This decline will lead to slowing production growth, but with a lag. So we have a situation where production is going to go up, demand is also forecasted to go up. Now, the point isn't necessarily whether production is going to continue outstripping consumption. Remember, what we care about here is volume, right? How much natural gas is being moved around. You can have a lot of demand, but if there's no production to support the demand, these guys cannot really do much. But what we have here is a lot of production. So it's a different kind of scenario, right? Now we have to be cognizant about what's happening in the world because at the moment a lot of stuff is happening with energy. So you got the Saudis and Russia cutting oil supply, bolstering the prices, and we have to be cognizant that that does impact natural gas to an extent. We have to be cognizant that next year it's the election in the US, and the Biden administration is doing what it can to maintain fuel prices stable. But nevertheless, the supply is expected to remain tight. So, what else should we be thinking about? Well, we have the conflict in Ukraine, of course. Uh, when the Israel war broke out, you can see how that impacted here in October the stock quite a bit for the better. We don't know yet how that's going to evolve. Um, it may fade away. It may be further escalation or other conflicts coming out, but we have to recognize that as one of the risks. Um, a few other things that we should be looking into as well is what is happening with this sector as a whole. Because in the specific area where these guys are based, the Permian Basin, there seems to be quite a bit of M&A activity. So, for example, Exxon, it's zoning in its core operations in this basin. At the moment, they have 11% of the production, right? And I wouldn't be surprised that these guys knock on Targa Resources' door for an acquisition. Part of the reason for that is two things. First of all, the market cap of the company, 20 billion, definitely, sweet spot for an acquisition target. But also in the past, they had a failed merger a few years back with different players that failed. So there seems to be some kind of aspiration um, from management to take the company to a new level, if you will. So I wouldn't rule out the possibility of an acquisition. And by the way, It's not unusual for those things to happen in the last few days of the year. So I think the timing, is a possibility. Could be happening by the end of the month, perhaps early 2024. Who knows? Now, what else am I seeing to come to that probability? Well, these guys know that the appetite from acquirers is more focused on cash flow generation rather than volume, which, as we said, is the business model of these guys. Yeah, and the company is taking steps to deleverage their balance sheet. So at the moment, uh, their their leverage is between 3.6 3.7x and is expected to decline between 3.4 and 3.6 by 2024. So management's taking steps to deleverage that balance sheet. I mean, they know that that's what buyers are looking for. They know that there is a period of consolidation taking place, and that doesn't necessarily apply to mega deals only, right? We see that happening with market caps between 3 and 30, so this definitely fits the bill. So potentially a lot of volatility here. Um, we could have an acquisition, we could have conflicts, we could have, of course, supply cuts coming from these different producer countries. Uh, we, of course, could see some kind of pipeline, natural gas pipeline blowing up around the world. Winter, if weather doesn't behave, could also be a factor, right? The PMIs, supply and demand, um, and as well, there are some contracts announced for Daytona pipeline which are becoming online in 2024. So plenty of things here, right? Now, interestingly, at the same time, if we go back to I think, our chart, look at the options, and it's very likely that I use options to structure this play. So you have implied volatility at around 23%. So that's not a massive implied volatility. So this is for end of Jan. If we look at April, it's around the same, right? So relatively low, especially for a stock with this historic volatility of 31%. So this could be an interesting time to buy volatility, well, to buy options that are low, are priced low in terms of volatility. So let's look at the beta. Uh, yeah, 220, right? So it's quite uh, low price to pay for options when you have a beta of this level. So if the stock starts moving violently, then those options could pick up in price very, very quickly and rapidly. So this is one that I'm gonna keep in the watch list. I don't see any imminent catalysts, although the acquisition example could happen overnight. So possibly structuring this with options on a ratio, maybe on a calendar, but definitely one that I'd like to keep around. Uh, Hope you enjoyed the video. Please subscribe and see you soon.